Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonell, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital or Sunpoint Investments.
All right, gentlemen, how are you?
Good. How are you?
Good.
What's up, Justin?
Today, we are going to tackle the topic of trend following and sort of work through what trend following is, the pluses and minuses of it, how it might be able to be deployed in various investment strategies, and a whole bunch of things related to that. But before we get into that, we do have a exciting announcement to make, and that is on April 30th, the three of us, along with a few other folks, are going to be involved in a full day of knowledge sharing and podcasting and discussions around the markets and investing and strategies with, I think, almost 24 guests. It will be live streamed. The event is called P&L for a Purpose. Jack is pretty much spearheading this single-handedly. Actually, I shouldn't say that. There's a pretty big team of people that Jack's been working with to get this thing organized and off the ground. So Jack, I know you put in a ton of work and effort into organizing this. So yeah, are you excited or what?
Yeah. So we're working with our friends at Spot Gamma. People have probably seen Brent Kachuba on our, on the podcast I do together with him. April 30th, 8 a.m. to 8 p.m., 24 interviews, each half an hour throughout the day. We're going to all share the hosting duties. We got great names, like all the biggest guests we ever had on Excess Returns: Jim O'Shaughnessy, Jem Kersan, Mike Green, Andy Constant, Katie Stockton, Wes Gray, Tobias Carla. I won't read them all, but we've got a lot of great guests. We're doing it all to raise money for cancer. It's right now, if you go to our YouTube channel and you click on live, it's there. And you can click a little notify me button, which helps us get exposure for it, but also will get you notified when we actually do go live. So yeah, we're really excited to do it.
This is the first live TV thing you guys have done, right?
Correct.
Yeah, I just did one the other day with, I've been a guest on live episodes, but we've never done our own. And then I just did one with Brent the other day just to test all the stuff to see if it would work live. But yeah, people have seen us with these recorded interviews. Now they have to find out if we can actually do it live. And the answer may very well be no, man. And then we're gonna have to deal with the consequences of that. But I think we probably can.
So is launching an ETF scarier or launching a multi-hour live episode scarier?
Yeah, well, I think that the scary thing for me is not that we can't do the interviews. The scary thing for me is that the tech is going to fail at some point. That's the thing that I'm spending all my time trying to make sure we have backups of backups of backups. There's obviously the thunderstorm at my house is going to occur right in the middle of this thing because that's just what happens. Or the guy's going to be out front cutting the power line for some reason because he's working the street or something like that is going to happen. So the plan is we got to have a plan for how we continue to go on, which is we just throw Matt out there by himself, basically, with some random guest that he's never heard of. And he just keeps going. That's basically the plan.
God is out there right now, finger hovering over that red button saying, what can I make go wrong? It's a great feeling, isn't it?
It is kind of cool though. I feel back in the day with the telethons they would have, they've got the guy, give all that you can, and then they've got the bank of people with the phones behind him. And I'm going to need you guys to find a bank of phones to be behind me in this. Cause that would be kind of cool with a bunch of people there, even though no one's going to actually call the phones. But it is kind of cool. And it's fun to be able to raise money for a really good cause. Everyone we asked to do it agreed to do it. So we've got a lot of people that'll help us get some great exposure. And also we're going to, do a lot to learn about what's going on. It's the day before the Fed meeting. We've got a lot of macro guys on. We've got value investors. We got people in the option space. So it'll be a great opportunity to learn and to hopefully raise some money along the way.
That's going to be really cool. Really excited to be a part of it. And Jack, you are the Jerry Lewis of live charity podcasts.
Probably not as charismatic, but I'll take it.
Okay.
Yeah, so that's going to be a great event. Hopefully people can join us. And the cool thing is people can kind of pop in and out. You can look at the guest schedule, see what time people are lined up. And if you're interested in macro, come in for the macro stuff. If you're interested in value investing, come in for that. If you're interested in, other types of things that we're talking about, you come in for that. So we don't expect people to hang out all day with us. So if you do, that's great. But I think people, and we're going to try to stick pretty close to that schedule on the half hour, with new guests rolling in, and that'll all be kind of outlined up front. So anyways, good stuff. Lots of effort and work going into that, but it's going to be a really fun and great day.
And by the time this comes out, I will have, like, in the YouTube description of that live event, I will have the schedule in there. So you can click on the video and you can see exactly who's coming on when.
All right, cool. Okay, so let's get into the idea of trend following. Trend following, it's interesting. It's like, I feel like depending on, after the financial crisis, I feel like trend following was more front and center just because of what had happened. And I feel like a lot of people were trend followers coming off of that, or like working trend following into certain types of strategies. And I mean, we've had like Jerry Parker on, who does trend following as a strategy. We've talked a lot about trend following on past episodes. We know other guys that use trend, but I don't hear it as much talked about, I guess, just in the last few years, just probably given what, has kind of transpired in the markets. If you think about the last bear market, it was like the COVID thing. It was 30 days of waterfall declines and then bounced right back. And so I don't think trend had a good, a lot of people that deployed trend following strategies didn't actually execute on any decisions during that period just because it was so quick. But anyways, so let's just, how would you take a stab at defining, I guess, trend? I guess there's a couple different ways you can think about it, right?
Yeah, what you said is really important, because there really are two major ways to define trend. And one is what you just said, which is the trend following, like a Jerry Parker does, is basically being long and short all kinds of different things. I mean, obviously we're trying to find things that are trending both up and down, and we'll talk about that later, but you can do it in different ways. So like Jerry could be long oil and short soybeans, and, long bonds and short stocks, and like all these different things at once. So it's like this massive long short portfolio. You're long the stuff that's going up, you're short the stuff that's going down. But for your average investor, that's not really the type of trend following you do. The average investor would use something along the lines of, when the S&P 500 is above its moving average, I'm long it. When it's below its moving average, I'm in cash. Like that type of thing is a simpler version of trend following that you'll see used a lot by equity investors. But it's important to break those down, because those are very different return profiles. I mean, obviously, if I'm in the S&P when it's above its average and I'm below it when it's below it, versus being long and short soybeans and a bunch of stuff, like that's going to end up with a very different return profile. That one is going to end up with a very different return profile than the other.
I think back to, let's take this to Newton for a second, as in like Isaac Newton. First two laws of motion: a body at rest stays at rest, a body in motion stays in motion until something happens. Like, simple as that. And whether we're talking about financial crisis and we go, why does trend work? Because all of a sudden that slow rolling 200-day or 10-month moving average stock price dips below. If you got out, you avoided the slow motion car wreck that was the next however many months of those bad returns. And so the body at motion, the equity market turning up and then toppling over slowly and then crashing for an extended period of time, that event, that crossover, was a really useful signal to take you out of the path of damage. The flip side of that is that in COVID, when it all happens over the course of 30 days, you get this whiplash effect. And the beautiful part about trend following is it gives you stuff to get you potentially on the right side of some arbitrary line. It can be systematically arbitrary, but you're picking your point. But the slower you make it, the more prone to certain types of whiplash you are, and the longer term you make it, the faster you make it, the same thing. You're prone to these whiplashes. So whether you're all in or all out, dependent on something, or partially in or partially out, at what speed, this is a big nuanced topic. And maybe that's why you hear less about it now. There are some convenient examples post-financial crisis of like trend works, but trend means a lot of things.
Yeah, that's right. And just to get to the basic definition, though, it's what we would call time series momentum. So in our momentum episode, we talked about cross-sectional momentum and time series momentum. Cross-sectional momentum is when I'm comparing the momentum of one asset to another. Time series momentum is when I'm comparing something to itself. So for trend following, for time series momentum, all I need is effectively the price history of the asset I'm looking at. I don't need to compare it to anything else. And we will kind of have a little bit of a deviation from that when we talk about Gary Antonacci's work. But that's the general idea is I'm trying to compare the return of an asset to itself.
One of the things that, we hear sometimes is you hear these macro folks come on and they're talking different ideas. in macro investing, but a lot of times I'm thinking of like somebody like Katie Stockton, where momentum sort of kind of is the basis for where she's seeing opportunity or places in the market that she's avoiding. But how would you respond to the question of, isn't trend following just like kind of a form of market timing?
Yeah, that's a really good question, because we kind of talk out of both sides of our mouth to some degree, because we always say, like, as quants, you don't want to time the market, but then we're like, and here's our market timing strategy, with our trend following. And so, but there's a big difference between the two. So me trying to, read Matt's newsletter and time the market based on Matt, seeing what he's seeing in the macro environment is very different than a systematic strategy that's using purely numbers and historical testing to determine when I should get in and when I should get out. So
let me be clear, Jack, though. That's my TikTok account, not my newsletter.
It is, yeah. I get it confused. You put so much stuff out there these days. I'm getting confused the various sources. Because I obviously take every piece of content you're involved with. I make sure to ingest that. But anyway, so yeah, the general idea is like timing the market is generally a bad idea. But there are benefits if you can be more right than you are wrong in terms of getting out of the market. There can be benefits in terms of limiting losses. And so if you can find a systematic way to do that, or a way that works over time, there can be advantages to that type of thing. So is trend following market timing? Yeah, I mean, by definition, it technically is, but it's a better form of market timing in that it's actually backed up by data in terms of what works over time.
In terms of, I'll make a musical reference to this. It's, you have to know something is in style and then do the thing that's in style. And so maybe my ultimate trend following music is definitely the surf music of the late 50s and early 60s. And it works in time. There's a place for this thing. It's taking this Southern California surfing thing, and whether it's Dick Dale or the Beach Boys, it takes over America as this exciting trend that everybody gets on at the same time together. But then, if you notice, there's not really any surf music in the 70s, for example. There's not really any surf music hardly at all in the 80s. And then Quentin Tarantino comes back in the 90s and Miserlou is in Pulp Fiction. So with all these things, there's the timing example of that's what trends are. They're things that become trendy at some point in time. Is it market timing? Yes, but if we call that market timing, then we call every decision to get in or out or add more or take away from market timing. And again, it's the nuance of these terms. They're so important to understand they're nuanced.
Is there surf music now? I'm trying to think, like, is Jack Johnson surf music? Does that count, or not really?
No, that's probably like some, like, I don't know, like California chill, or that deserves some other subgenre name that I'm sure exists. But there are lots of great like surf and surf rock bands and instrumental surf rock bands. I'll see if I can figure it out before the end of the episode. I just saw one a few months ago who's this amazing band of brothers, and the guy plays like surf ukulele through an amp. It's fantastic. It's out there if you're willing to look, but it's not trendy. There's no like hit. Like there's no Ariana Grande surf song to my knowledge right now that's dominating the charts or something.
Well, and I think the one big difference here is when you're market timing, you're making some type of decision, or you're making a change to your portfolio or your investments based on what you think is going to happen in the future. Whereas trend following is always based on what has happened in the past in terms of that signal. And so there's a very different and important distinction there, because if someone says, I think the market's going down, sell in May and go away, that is someone that's making a decision, they're timing the market. Whereas if the S&P closes, below its 200-day moving average over the past 2 months, and someone decides to sell 20% of their portfolio, that's more of like a trend following type of decision. So that's just, I think, another good way to think about what those differences might be.
Yeah, as quants, we want to find stuff that works. We want to find stuff that we can say historically has worked out. And the problem is me trying to figure out when I should go in or out of the market. There's no evidence to believe to suggest that would work. And so if there were macro strategists who had, could use all the economic variables and could figure out when to go in and out of the market, like that would probably be a similar strategy to trend following if it worked. But the other big advantage trend following has over that kind of stuff is, because trend following is using price action, during like most of the major declines, you're going to be saving some of that decline for the most part. I mean, we'll talk about COVID, which Matt brought up before, later, but in general, with most major bear markets, because you're using price action, because you're using what actually is happening, like you said, you have a pretty good feeling that that's going to reduce losses. If I'm using macro variables or something and I get it completely wrong, I could completely miss a bear market. And so that is one of the advantages of trend following by using what we're actually seeing is you have a higher chance that you are going to limit losses when you do get that downturn.
So let's talk about the return profile that we might think trend following might give us versus something like a buy and hold. So let's just make it very simple. Let's say using the S&P 500, we're going to deploy, we're either going to buy it and hold it for, 10 to 20 years, or we're going to use trend following. I think I'll take the buy and hold sort of return profile or expectation is, you're probably going to get something over most 10 or let's say 20-year rolling periods in the S&P. You're probably looking at something like, let's say, an 8.5 to 10% return, somewhere in there, based on what the S&P has done historically. But if you expect that you're probably going to go through a bear market occurs once every 5 to 6 years, it might be a little bit, this is post World War II, but it may be a little bit less now. But if you get a bear market that coincides with a recession, you're probably looking at something like down 35 to 50% in a worst case scenario. I think the S&P has lost 50% of its value, either 2 or 3% or 2 or 3 times since the mid 1920s. Anyways, that's what you get with a buy and hold. You can get really solid long-term returns, but if you're going to stay invested in the S&P, when those drawdowns happen, they can be very painful and they can be very scary. And a lot of times that's when investors tend to make sort of the worst bad decisions. And so I'll kick it over to you guys in terms of what the return profile might look like if you're up, and it's going to depend on the trend following system, but sticking with the S&P, what you would get if you deploy trend on it.
Yeah, well, Meb Faber's paper is a good place to start here. So he used the 10-month moving average on the S&P 500. And effectively, and we have a trend following tool on Validia as well that we've tested back in the 70s. And our results are pretty similar to his. And the idea is, I always like to say, you should assume probably the same type of return with about half the drawdowns. In Meb's paper, he got, 0.9 or whatever, like 1% better return. And I think our thing shows something similar. But I always say, like, the idea is you probably end up in about the same place, but you're chopping off part of the drawdowns, a significant part of the drawdowns along the way. Now, the problem is, if we look at how that actually works in the real world, is so the S&P is moving, for long periods of time, the S&P is going to be above its 200-day moving average. I'm just going to be invested. Then there's going to be things like 2008, where the S&P breaks below and everything works out perfectly, and I missed the entire drawdown. But then there's going to be, it was almost, most of these were down almost nothing in 2008.
Yeah. Okay.
But then there's going to be the horrendous amount of false signals along the way. And obviously the longer term moving average you're using, the less you're going to get on the false signals. But the idea is it's going to say, get out of the market, something's coming. It's going to be wrong. It's going to say it again. It's going to be wrong. It's going to say it again. It's going to be wrong. And so like these things are right like 30 or 40% of the time, something like that. And they're wrong 60, 70% of the time. The reason they work is because when they are right, they're right to a much bigger magnitude. So if you think about, like, if I missed most of 2008's drawdown, how many bad signals can I have after 2008 where I'm still ahead? A lot. And what did I get, by the way, after 2008? A lot. Since 2008, it hasn't been pretty with the trend following. So that's the problem. And we'll get into the behavioral stuff with this, but that's kind of what the return profile looks like. You get probably a similar return with less drawdowns, but the price you're going to pay for that is a lot of false signals along the way as you get there.
This ties back into the sequence of returns risk episode we just recorded too, because it's, if you lop off the bigger drawdowns, then the amount that you're compounding at the rest of the time is allowed to be lower. So if I lose 50% of my value, like in the financial crisis, I have to double before I'm even back to that starting point. If I can reduce or minimize or totally avoid that 50% drawdown, to your point, I can have much lower forward returns for a period of time until those averages converge back on each other. That's a super important point in this when we think about how do these things stack up. And by the way, if you didn't get the benefit in 2008-9, and then you've been eating it doing trend following in the period after, This is why you got to stick with strategies a long time, right? You need these things to make them work.
This is the problem with all these risk reducing strategies is everybody flocks to them right after they've had their best possible situation.
Exactly.
The same thing with the permanent portfolio. Like everybody flocked to all this stuff after 2008. They're like, oh, trend following kept me out of 2008, or I would have, I wasn't actually in it. And then you get the harder part of the strategy, which is sticking with it when everybody else is making money, in long only. So it's one of the challenges, like with anything like this, if you're going to use it, and we'll talk about sizing it and stuff later, but if you're going to use it, you have to hold it across very long periods of time because you don't know, when it's going to work and when it's not going to work.
And 2 clarifying points. So this is a letter of kindness to myself, 16 years ago when I start reading about this stuff, is the 10-month moving average, the 40-week moving average, and the 200-day moving average are all effectively the same thing. If that's not obvious to you yet, I was once that person. So let me confess that right now. And then beyond that, we're talking about the all-in, all-out versions of this. So this is, again, the long only. I'm not short anything. I'm all in on the S&P, then I'm all out. The thing when you go all out, if you're putting it in the money market, influences the return. If I'm all out of that, but I'm all into long-term treasuries, that influences your return. And just the nuance runs deep at the signal levels and on what you do when the trend is against you level.
I think there's another really interesting and important point here with trend. And I'm kind of going to bring it back to market timing for a second, but remember, there's the decision to get out and the decision to get back in. So if you think about the financial crisis, the people that went through it, that made a market timing call afterwards, in some cases, it may have been 5 years after that bear market was over that they finally got back into equities, or maybe they never did. But a trend following system, one of the big benefits to it is one is, it can save to the downside in those big declines, but there's a systematic buy point where you're coming back in. And that's extremely important. It gets you back invested and, it allows you to have a chance to, then let equities compound and grow for you. So it's not only the sell, it's also the systematic buy. And that's important because we'll sort of talk about the emotional aspect of it in a little bit here, but I'm kind of hitting on it. It's, a lot of people, when they go through those types of market environments, they get really scared and it can dramatically influence their decision-making process. And this is where trend following, I think, can help there.
Yeah, and that's such an important point because I think that buyback is the harder of the two decisions. If you put yourself back in like 2009 or something and you sold out, you thought the world was coming to an end and you sold out and the market starts going against you. It just keeps going up and up and up. Like you don't want to buy. You want to believe I was right. This is all going to fall apart. This is all going to crumble. And then years go by, you're still wrong. And like, I'm sure you've seen people like this, Matt, they do that and they don't ever get back in, or they don't get back in for many, many years. So one of the advantages of trend following is there is a systematic rule that you're going to get back in when the trend is reestablished. You're not going to sit here and worry about all the catastrophe that could potentially be going on in the economy or everything else is affecting you. You're just going to follow the trend.
The, hey, dummy, look, this is happening is such an important anchor. If we're going to take it just to at least one behavioral financy point about this whole thing, if nothing else, even if you don't systematically use the 200-day moving average to build and construct your portfolios with stuff, it's a really good, hey, dummy test where you can say, stocks are above this thing. They tend to do well when they're above this thing for extended periods of time. It can be a good litmus test, even if you don't live or die by it. But certainly for the people who sold out of stuff, needed to be proven right, and then stayed out of that stuff, even if you don't systematically follow these things, just using it as some of your, hey, dummy rules can be tremendously useful.
Another thing, just as a side point too, is the S&P is significantly more volatile below its 200-day moving average. So if you look at the standard deviation of returns of the S&P, when it's below its 200-day moving average, it's much more. So you are kind of avoiding a lot of that volatility to some degree. What do you got a point on that, Matt?
Yes. And this is the ultimate, again, to take us back, however, how many years are we since the financial crisis? What young wee lad was I at that point? At least in my career, all the love to the American funds wholesalers and whoever else forever would pass me in my old days. The chart of time in the market is more than important than timing the market. And if you miss the worst days below, The 200-day moving average, you get typically the best and the worst days, often side by side in the market. So yeah, they're more volatile, but all those best and worst days things, they usually happen below because that's when stuff gets the craziest. And to your point, that's another good thing to remember. It's, the best and worst days both tend to happen side by side in those sub or anti-trend periods.
Let's get a little bit more granular on sort of the different ways that someone might go about measuring trend. Obviously, like we said, you have some of the more popular ones, the 50-day moving average, the 200-day moving average. So in that case, you're just taking the last 50 days of something like the S&P and you're looking at the average level. Let's say you could, I don't know where the S&P is right. Where is the S&P right now? 5,200 or something like that.
It's almost 5,000. I think it's been, it's been a little.
Yeah. So that's one of the more common ways, but there's a few others that I'll let you guys, Jack, you can kind of lead that up. But I'm going to bring up the tool on Validia just to see where we're at here. What are some of the other ways that we might measure trend as well?
Yeah, this gets back to what Matt was saying before. Like in our simple example, we have the 200-day moving average. When we go below the 200-day moving average, we go all out, or we go all in when we're above it. In practice, you don't almost ever see that. Because by betting on the 200-day moving average, you're betting on one thing. By going all in or all out, you're taking a big risk around that one thing. What you'll see, and like our friend Corey Hosstein, the guys at Resolve did this, is the best way to do this is use as many moving averages that work as you possibly can. Like they got to the point where they were using all of them, like the 199, 198, 197. Like take a small portion of your portfolio and tie it to each one of these things. And we'll talk about different ways you can do it outside of moving averages. But the idea is if you want to get the average of all this stuff, that's probably a better way to do it is move your cash allocation in or out slowly based on a lot of moving averages, but versus let's just sell tomorrow. Now the sell tomorrow can work spectacularly well if you get it right, but it can also be spectacularly wrong. And maybe this is, Matt, I think you have a point on this, but this is a good time to talk about COVID too, because that's a good example of that type of thing.
Anytime we get in love with a strategy that helps us do this stuff, or we're interested in it, or we're trying to implement it, we have to be aware of when are the times we are going to be most painfully wrong. Whenever you buy or sell something, one of the realities is, and somebody said this a long time ago, so attribute accordingly. Jack, I think you'll tell me it was Mark Twain, and I will totally agree with that point. But whoever said it, Howard Marks or somebody probably, made the point that when you're in and out of something, you don't just have to be right once. You have to be right when you sell it, and you at least have to be right when you buy it back again. That's really friggin' hard, especially the more compressed the timeline is. So in a case like the financial crisis, it might have been midway through that summer, if memory serves correctly, of 2008. Finally, price and trend, the trend line, the moving average converge, you get out. And it's not until the middle of 2008, you're not back until like the middle of 2009, back into the market at a much lower level. So I sold high, I bought lower, not at the low, but lower. That's really important because I'm right twice, and that's what's helping my results. In any case, and COVID would be a prime example of this, if the market pukes and I sell low, but then the market shoots way back up, and now my trend signal says, buy it back, what might have just happened is I might have just sold low and bought high. And what I ended up doing is, in tax terms, resetting my cost basis, resetting my entry point in a way that is very unfavorable to me, at least to my short-term results. Because if I book a 20% loss and then go chasing back in, that's not helping anybody. And this is one of the things that makes it tremendously hard to do in the real world, because these whiplash signals they're just savage.
Yeah, and that's where the composites come in, because like one of the things I've learned in investing is whenever a thing works and you can define that thing a bunch of different ways, like do the average of all the different ways. Like a value composite is a good example of that. Why would I invest with the price to book when I can use a composite of value factors? And like, there's nothing special about the 200-day moving average versus the 197-day moving average. So why would I not use all these moving averages and get the average of it over time? I'm not going to get the best one. I'm not going to get the worst one, but I'm going to get a smoother ride. And also I'm going to avoid this all-in thing, and all out can be very challenging behaviorally. And also maybe for tax reasons and other reasons, it's not great. So using an average, you're kind of slowly moving in and out of things. You're not going to get it perfectly right, but you're going to get the average of what works, which is this whole idea of trend following. And so I think that's a better way than trying to pick, a lot of people want to pick the exact moving average. And, we could run a test right now, Matt, and we could be like, let's take every single moving average and test it back to 1932 or whatever. And you could say, well, the 187-day moving average is the best moving average. But the reality is that doesn't mean anything going forward. Like the 187-day moving average is not really the best moving average. You probably want to just get an average of these over time. You're not going to pick the best one.
If you optimize around any single variable, and this is a rule, single variable analysis is always extremely dangerous, because as soon as you optimize around a single variable, inevitably you've made something that works exceptionally well in the rearview mirror. And unfortunately, you are hurtling forward on the highway of investment returns, and that one variable is not the thing you want to choose to live and die alone by. So it might be with layers. You might have 3 moving averages that you're using. You might be using Bollinger Bands and like distance from an average and saying, I'm going to size and shape positions off of these things. Single variable, high risk, high danger because of these whipsaws.
One of the things that the data shows on our site is that, at least with the simple trend following model we have on Validia, is like things like commodities or these asset classes that have, and I mean, stocks, when they go into really bad bear markets, would be one of these. Cause I mean, we know that stocks can be down, 40 or 50%, but commodities tend to be, they tend to have these like big boom and bust cycles. So, using trend on something like that, at least in our historical data, shows that it does outperform like a buy and hold. Of course, we'll talk about the challenges of deploying. We've already talked about some of the challenges, but it's those types of, I think, asset classes where trend might shine a little bit better versus some of the more standard ones like stocks.
Yeah, commodities are a great example because they have those, what they call super cycles. And so I think of everything we track, I think it probably has worked the best on commodities because they've had these really, really long cycles, in both up and down, and it was down for a very long period of time. But the longer you have these trends and the longer you have these cycles, the better trend following is going to work. So yeah, I think commodities is a place where it tends to work very well.
Super cycles and the boom and bust. Those are the things that tell you there tends to be more of like a range that these things might move in, and they move sharply and extremely in directions. And with trend following, that's what you want. You want the extreme moves in either direction to hopefully capture them on the long side, avoid them on the downside, unless you're doing long short, in which case you want the big moves in either direction. That's what trend is supposed to be helping you solve.
So let's just flush out what the biggest challenges with something like this might be. And I think we've kind of hit on these a little bit, but let's get a little bit more sort of specific and make sure that it's clear. Jack, I think the point you made earlier that, even the best trend following strategies, they still have, very low batting averages. They don't get, there's a lot of whipsawing that happens in between the periods that you get the benefit from it, right?
Yeah, that's right. Like we know these things are going to be wrong more than they're right. I mean, that's basically built into them. So, most of the time you're going to be looking at a signal that's wrong and you're going to have to buy back higher, which you don't like doing. It's behaviorally very challenging. So yeah, that's definitely a downside of this. Also thinking back, I want to make that point about the COVID that Matt and I were talking about before. If you use like more single indicator systems, the other problem is you get it wrong. So if you think about what happened with COVID, we had a very, very massive decline very quickly and then a huge bounce back. So if you look at the different types of trend systems, like the short-term moving average guys did pretty well in that because they got out pretty quickly. The intermediate term guys, did the worst because basically they got out right when it was about to go back up. The long-term guys, it didn't phase them very much because they never, they didn't get out much in the first place. And so that's an example of why you want to have, you don't want to use these single, factor systems because you want to have some short, you want to have some medium, you want to have some long, you can even use those, what they call the death cross, which I hate the name of that because it implies the world's about to come to an end or something. And it's definitely the data does not show that the world's about to come to an end, but even these moving average crossover systems can help too. The death cross, by the way, is when the 50-day moving average goes below the 200-day moving average. And no death and destruction does not happen at that point. But
and also rivaled by, isn't the golden cross when it goes the other way?
Yes, I believe so. So
yeah, so death.
That's one of the things with investing is you give things, the bigger name you give it or like the more aggressive name, people love that kind of stuff. So Like if you can say the death cross on CNBC, people are like, oh no, this is a huge problem. But if you test the death cross historically, it's not the problem you think it might be.
So I issue the challenge to you in the trend following community. I'm looking for I want 4 variables to confirm the trend, and I want to refer to it as the Quad City DJ cross.
Oh, I like that.
Every time we do it, we do a "Come on, ride the train, that choo-choo, ride it" reference.
Oh, nice. Yeah, Justin, I think our clients would love that if we implemented that.
We can roll out that strategy.
I think they'd be very
the Quad City DJ momentum strategy. Please.
Every time we go to cash, we like send them the audio file or whatever, and it just starts playing the music.
It's a jam.
We'd be differentiating ourselves in the market. No doubt about that.
Well, and I think, the other point that you brought up is obviously taxes can be a big issue here. Like imagine if you were utilizing trend, it got you back in at the end of, or somewhere in 2009, you rode it all the way up. Maybe it didn't, because I know with our trend following system, like we had false signals in, I think it was 11, 15, and 18, something like that. End of 19, maybe. Those were periods in the market where the S&P was down almost 20%, and our system was kind of reducing risk, and then the market kind of turned because none of those bear markets was really coincided with a, economic weakness or recession. It was other things driving it for the most part. There was concerns about that, but didn't materialize in that way from the economy standpoint. But the point is that, if you had taxable money invested in a trend following system, you would have had forced sales there, which would have generated, probably pretty big tax consequences. So that's another important thing to sort of keep in mind here.
Yeah, it's just something everybody individually has to think about. What is my own tax situation? Obviously it doesn't apply to IRAs, like if you're managing non-taxable money. Also, these things can now be embedded in ETFs. So some people run them inside ETFs. So in that case, you can avoid it that way. But it's just something to keep in mind. Anything that's doing any buying and selling, taxes always have to be something you have at the top of your mind when you think about it.
We've talked about it in some of the episodes, especially with Lee Bodoris too, where you're looking at churn, you're looking at turnover. There's ways to look at all these types of things when you have more actively traded strategies, and just understanding, okay, if this is going to turn itself over, 300% over the course of the year, are these all short-term trading gains and losses? How historically have they stacked up? What's the kind of risk I'm putting on? And in some of these more composite, like CTA type managers or arrangements, depending on the fund structure, or if it's in an ETF or whatever else too, you can kind of look at these things and understand sometimes it's not so bad. Sometimes all of it's so like short-term in nature that a lot of the losses can offset the gains. There's ways to structure this stuff well. And there's also ways to do this profoundly stupid where you can just owe a lot of money in taxes, and congratulations. If Uncle Sam is getting all of your return, that's probably not the alpha you're after.
Yeah, that's a good point, Matt. What do you guys think of, and this word hasn't come up yet, but I think this is correct. It would be a correct statement, but isn't trend following like a form of momentum investing?
Yes.
Am I right about that?
Yep.
Okay.
Yeah, it's basically time series momentum.
Right.
Yeah, absolutely. Okay. A lot of people will get into the nuance of that, like in the factor investing world, and they don't like using the word momentum with trend following, and they like having momentum be the cross-sectional thing, and trend following is the the time series thing. But realistically, yeah, it is 100% a form of momentum.
And it's a style. Back to the surf guitar thing. Like, it's just a style that sometimes is vogue and sometimes is not. Extra Madonna reference in there. So it's one of those things. Different flavors of this thing are going to show up. And yes, it's momentum because it's focusing on, in many cases, the underreaction to good news as it comes out over time, or the underreaction to bad news on the short side. And this is just a reality. This is a way that humans work. AI, what's that? NVIDIA starts. Oh, this is a cool thing. We do this. It keeps going. Oh my God, every company is going to put this in their name. It keeps going. These trends build, and this is just one way we try to make sense of how us crazy humans run around in our day-to-day lives.
I know when we've had Jim O'Shaughnessy on the podcast in the past, he's talked about this idea of 2 points of failure. And I think you wanted to relate it to trend following.
Yeah, well, the idea is like thinking about which investors trend following works well for. So the 2 points of failure are, if the market's down a lot, people will typically panic and sell. And the second point of failure is if you underperform whatever you consider your benchmark, the S&P 500 or whatever people are talking about at the cocktail party, you're going to panic and sell. And so the question is really whether trend following addresses the first one very well. It's limiting drawdown significantly against buy and hold. It is horrific on the second one because you're sitting in cash a lot of the time when your neighbor is making money in the S&P 500. And that's very hard to do. And so what I was getting at there is I think the type of investor this works with is really the person who is more focused on that first point of failure than the second. And it's hard to figure to, maybe Mac has some ideas on how to suss that out with clients, but the person who's more worried about losses than they are about keeping up with their neighbor, that's really where this works really well. The person who's really worried about keeping up with their neighbor and talking about their returns at the cocktail party when the market's up, this is a really bad thing to get involved in because you're going to have these periods where you're out and they're in.
For most people who just can't stick with a systematic strategy to begin with, which is a lot of people, like the default setting for most people, unless they're willing to totally take their eyes off it, stuff like this is not going to serve. You're not cool at the cocktail party when you're like, let me tell you about the merits of 10-month moving averages. That's not a sexy concept. But owning the thing that works right now, and I would say the same is true for momentum, can be, if you're the type of person who goes to cocktail parties and wants stuff like this to talk about, this is a tremendous tool. I can take the S&P 500 and I can sort it by give me every stock in the S&P 500 that's trading above the 200-day moving average. And I can use that as ways to identify what's trending, why, and how. As a rubric for figuring out what you're interested in, what keeps you invested, momentum or trend following can both be really interesting ways to always own something that's doing well. Doesn't mean it's going to do well for you. Doesn't mean your advisor is going to like you doing it or whatever else, but it's a handy tool. And it makes it one of those things that when we track stock portfolios or we track things that are going on, I'm always going to pay attention to stuff like this just because it helps me understand where are the trends and what's happening now. Again, shout out back. The band I was talking about before, the surf rock band, they're called Disposable. They're from New Jersey. They don't have a lot of stuff online. It looks like they're on Bandcamp somewhere. Great band, ukulele, surf guitar. It's wonderful, but they're not top in the charts right now. So if Billboard is my equivalent 200-day moving average, I can't pull up the Billboard chart and see my favorite punky surf rock band at the top of the Billboard charts. And that's my indication that I can't play the cool card when I drop that name with somebody who only cares about Billboard stuff. These things are tools, and if we understand the nuance with them, we can figure out how they serve us best in the places we want us to serve them. And last I checked too, cocktail parties are not the determinant of net worth, or is that the way we measure net worth? Not sure.
I think another problem you have here with trend following is in like December 2000 or December 2008, there probably weren't too many cocktail parties. So like that's the time as a trend follower, you want to be at the cocktail party, telling all your friends about how great it's doing, and they probably aren't having the cocktail party. So I don't know if I can put that in the academic research, but that is probably a problem with the strategy.
Can you design me a cocktail party oriented strategy that in times of pandemic, like all I do is I don't know, in a pandemic, I just go buy the Qs or something like that. But in cocktail party times, I get like the hottest meme stock and I don't know, Bitcoin or something.
Have you guys seen that video of like that's going around Twitter of like the guy dancing on the stage that they put everybody's face on? Have you seen that? Like it's like a celebration video. I think it's like the guy that did what's it called? Gangnam Style or whatever. But they like impose like the guy that got the macro call right or something. They'll impose his face on the video and like he'll be the one dancing out
when
there.
He pops out through the stage like that.
Yeah, this is a different one. The same idea though. It's like the guy dancing all the way to the end. It's like the same concept, but that's basically you as the trend follower, like in, December 2008. I mean, you may have other problems in your life, but that's you. You're like dancing out there and you can't do it because nobody wants to go to the cocktail parties.
These are the things you got to think about. Are you doing this for wealth creation? Are you doing this for status? It's okay to know if you're doing something like this for status, just figure out the way you want to talk about it, the way you want to track it, the way you want to do it. And by the way, lots of people, when they're out there marketing their strategies, they're saying, this is what we do for clients. That's what they're doing. They're not selling you wealth. They're selling you some idea of status around this idea that feels good. That aligns with your behaviors, then maybe you should pay attention to it. But if it doesn't, it's okay to ignore this stuff too.
So for us, there's a couple different ways that we use trend following in our clients' portfolios. We have specific equity strategies that can sort of flex in and out of the market based on our trend following system. And then we have these risk management models that utilize trend to move in between different asset classes and or also can increase their cash position. If, let's say, the majority of asset classes are in a negative downtrend, then that might be a signal for those strategies to start moving or reducing risk, moving out of the market or reducing risk. But in terms of like position sizing these and actually like deploying these in client accounts, we mostly, it's not 100 for most of our clients. It's not anywhere near 100% in either one of those. It's like they're mixed with other long only or diversified strategies. We're just trying to give them some exposure to trend to allow them to benefit from those types of strategies when they get it right. But it's not, it's not anywhere near 100%.
Yeah, sizing this stuff is so important because to your point, we don't have one client that's 100% trend following. And I don't know that we have one client that could stick with 100% trend following. It's just too hard. Like those periods where it's not working that can go on for years, you're going to abandon it. But if it's 20% of your portfolio and you're using other risk management methods and you're blending them all together, then it makes sense. If like somebody using a 60-40 portfolio keeps, a strong bond allocation, but also uses trend following for part of their portfolio, like they take some from the stocks and some from the bonds and use trend following or something, that's where it makes a lot more sense. Because then it's not having such dramatic impacts on your portfolio that it's when you're wrong that you can't stick with it. And that's just a generally good idea in investing in general. It's like all this stuff that makes you look different. If you can blend that stuff, if you can size that stuff appropriately, it works out a lot better than if you think you can like put 100% of your money in it and stick with it.
We think about, so professionally at some point in the way we construct portfolios, we think of stuff as either the big two buckets are, is it either a risk seeking thing or is it a risk mitigating thing? And then inside that we have subdivisions. And something like trend following, it's never going to be everything. It's going to be a sleeve. And most trend following strategies are either going to be hybrid or risk mitigation in some way, where we're going to say your real purpose is to help us hopefully avoid some amount of drawdown, and here's and why. We don't often use these strategies, but if somebody has one or somebody has a CTA, we just want to make sure we understand, is this the kind of thing that's going to introduce more volatility to the portfolio in some way? Maybe it's a commodities only CTA or something that's got just wild standard deviation to it. We don't usually advise on those things or suggest those, but some people are going to have them and that's okay. And then in the other direction though, it's okay, if you're going to give me just a lower vol, what's the contribution to the rest of the portfolio? How do we fit that in? And then how do we size it? The weird thing here too is that means if your volatility profile and your correlation to the other things in the portfolio is that of a Vanguard intermediate term bond ETF or something, well, now we have to look and say, is it smarter to do this or that? And that's the other thing that these strategies do. When you start to take off the label and look at the factors as they're defined, then you start getting into the conversation about what are the descriptions we use of how this thing acts? And then what are my other alternatives that have the same of these descriptions? And that could be a huge influential detail on where these things fit into a portfolio, how you size them, what the tax considerations are, and all that other good stuff, but crap. Let's be honest. All that.
And it can also be blended, like within a certain strategy, you can have trend following blended with other risk mitigation techniques. So like time series and cross-sectional momentum, the portfolio you mentioned, Justin, that we run has both components. It has a trend following component, like get me out of the market if everything's going down, but it also has a cross-sectional component, like buy the assets that are going up the most. And so you can mix a lot of this stuff together. Like, or I know Alpha Architect, like in their, they have two different systems for sort of the time series thing. So they have one system where they use moving averages to determine whether to get out of assets, but they have another system where, if you look at basically the return of the asset versus the risk-free rate, and and this is something that comes, I think, out of Gary Antonacci's work, like if the return of the asset is below the risk-free rate, that's when you go out of the asset. So there's a lot of blending and combining and things you can do. And typically the more blending and combining you do, the better, because you're getting like the average of all these, you're getting the average of the different trends, but you're also getting the average of the different risk mitigation techniques. And like all of it comes together into something you can stick with better than trying to use one approach.
So here's one for you. Why did Jack, the trend following YouTuber, cross the road?
This is what I'm here
I'll let you
for.
take this one.
Is this a
I'll just give you the
GPT?
punchline. Yeah,
Please.
So yeah, why did Jack, the trend following YouTuber, cross the road to chase after excess returns and hopefully catch some subscribers along the way?
Are you in ChatGPT again?
Yes, I'm ChatGPTing this joke all day long.
It wouldn't be a podcast if you didn't have like some sort of ChatGPT. Like, we should just have Matt and I will talk, and you could just continually type ChatGPT references throughout the podcast.
Oh, yeah. Actually, before we end, though, just share that latest experience with Claude and on the back.
Oh yeah, that was crazy. So I was having it like I was doing an article on free cash flow yield, and I was having it edit the article. So like, first of all, these things are really good. So anybody who's not using these LLMs, they're really good. And Claude to me is the best right now. It's Claude Opus is like better than anything else that's out there. But anyway, so like you give it the article, it edits the article. And now what it's doing is it's actually like starting up its own agents. So, and I sent it to Justin, like effectively, I didn't do anything but say like, edit this article. It gives back the edited article. And then two agents start talking to each other. And one is like, oh, I have some feedback on this article. Like you might want to do 3 or 4 or 5 things. And the other was like, wow, that's amazing feedback. And the other one was like, it was my great pleasure to provide this feedback. And it just keeps going. Like these two things keep like, they both have initials, like they're people, and they keep talking to each other. And like, it gets to the point where all they're doing, there's no more revisions to the article. They're just complimenting each other back and forth. One is just telling the other how great they are. And like, I finally had to stop the thing because it got so out of control. But it's amazing. Like these things are actually spawning off like agents that are talking to each other based on you just putting in a request.
I'm blown away by this.
I'll send you the actual transcript of it because I sent it to Justin. It's pretty crazy. And I think it was going to in an endless loop. So I don't think it was ever going to, like, it just got less and less substantive and more like complimenting each other. But I don't think it was ever going to end if I didn't stop it. I mean, they still might be out there somewhere on the internet chatting with each other. I just don't know about it.
It devolved into the worst cocktail party ever. It's just how's the weather? Back and forth forever.
That's where this stuff is going, though. I mean, Justin uses this stuff more than I do, but like, I mean, that's where it's going to go. It's going to go to the point where you can like send all these different agents to do all kinds of things. And not only is it writing or editing the article, but then it's bringing in other perspectives, like to edit the article even more. And it's pretty crazy.
So the trend here is that
more agents, I guess. I don't know.
More agents is the thing that's trending. Bots,
I guess.
AI.
This podcast is eventually just going to be 3 agents, and it'll probably be more entertaining than it is now. So,
except it'll devolve into boring.
We'll just do like this round compliment thing where all we do is just compliment each other for 55 minutes about like since Jack and I have never even given each other one compliment over like 20 plus years working
should
together.
Start now?
We got lots of catching up to do.
Or maybe we'll start with substance and then we'll devolve into the complimenting as it gets on, just like the agent did. Justin, those were some amazing insights on trend following in today's podcast.
Oh, well, thank you. That was
You must have studied extensively to be able to provide that kind of commentary.
Yeah. There you go. Nice. All right, guys. So thank you guys for checking this out, listening to us, and we hope to see you on April 30th. So we'll see you next time. Thank you.
Thank you.
Hi, guys. This is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbonneau and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.